Perfect. So we'll get a start on for everyone that's here in the audience, in person and virtually. For those who couldn't be with us in person today, hello from the interweb. But good afternoon, everyone. So it is wonderful to see you all at our first Housing Lunch and Learn. As many of you are aware, the Community Planning Division was established this year to reorganize some of the work that NVCOG had been previously conducting. In this reorganization, we were able to hire 3 new community planners. 2 are here with us today. We have Phoebe Plouffe and Emily Ritchie in the back of the room. We could not think of a better first partner for our Housing Lunch and Learn than the Connecticut Housing Finance Authority. Myself and Richard Crowther, our senior GIS analyst, had the pleasure to visit with CHFA earlier this year and see a version of the presentation you guys are going to see today. We knew then that we had to find a way to further partner to ensure that their knowledge and incredible resources would be shared throughout this region. That opportunity came sooner than we originally anticipated, because CHFA has kindly shared and supported our efforts in creating housing needs assessments throughout the region. A goal for us is to do a regional housing needs assessment, which will combine some of the work that CHFA has done and the support that they've provided us, but it'll focus specifically on the Naugatuck+Valley region, and we see that hopefully being beneficial to our partners, whether municipal or community-based. So the CHFA statewide housing needs assessment is a really great regional and a municipal tool to help support informed decision-making. And I would just like to give a round of applause to Phoebe Plouffe, our community planner, who coordinated this effort and this wonderful opportunity for us today, and our panelist, Andrew Bolger, senior research and data analyst, to tell us more about CHFA and to get into today's presentation. So.
Sure. Thank you, Samantha Copeland. Great introduction. And thank you to Phoebe and the rest of the team for putting this together. Really appreciate the opportunity. So as Samantha Copeland mentioned, my name is Andrew Bolger. I'm CHFA's senior research and data analyst, and kind of brief agenda for today. We're just going to dive into a quick overview of who CHFA is, talk about the recently published housing needs assessment with a particular focus on the Naugatuck+Valley region, and then talk about 2 new programs we're running in kind of reaction to the trends we looked at in the HNA. That's Time to Own and also Build for CT. So really quick, who is CHFA? We are a housing finance agency established by the Connecticut General Assembly in 1969. Every state has at least one HFA with the primary goal of kind of meeting the affordable housing needs of low and moderate income households in their respective states. States like New York have 2, one for the state at large, one for, say, New York City. And our mission specifically is to alleviate the shortage of affordable housing on both the rental and the home ownership side. As I mentioned, we're a quasi-public self-sustaining public agency, and we don't take state appropriation dollars. We do have the authority to issue our own bonds, and that's kind of how we keep the lights on, so to speak. So on the home ownership side, we provide opportunities and resources for first-time home buyers through below market interest rates, down payment and closing cost assistance, and home buyer education. We restrict that kind of assistance to first-time home buyers specifically, and they also need to be income qualified, and that generally is around 120% of the area median income. And just so, for example, in Waterbury, that income limit is dependent on household size, but ranges from roughly 143,000 to 167,000. We also restrict the home price limit to, and again, in Waterbury, $588,000 with the most recent update. On the multifamily side, we pursue the creation, acquisition, and preservation of affordable housing units. We do this through new construction. We do this through acquiring and converting market rate into affordable units. We also do it through preserving existing affordable units, and that's both preserving the affordability, but also the physical condition of the units themselves. We do that through programs like the Low Income Housing Tax Credit, Housing Tax Credit Contribution, CDFI small multifamily loan pool, that's a mouthful, and through our own competitive loan products. There's more programs than that even, but those are kind of the primary ones. We generally require in any kind of development, we do a certain number of units be restricted, reserved for income qualified tenants. Those are generally between 50 and 80% AMI, and you can see the example for a family of 4 in Waterbury there, generally 57,000 for 50% AMI and roughly 91 for 80% AMI. Any questions before I dive into the housing needs assessment there? That's really kind of quick 30,000-foot overview of what we do, how we operate.
Can I make a quick just announcement aside that I forgot to make before you started? Everyone that's here, these are our owls. There are cameras and our microphones. They're very, very sensitive. So like side conversations and phones and stuff, make sure they're super quiet. Because everyone who's listening online will pick up on that instead of picking up on Andrew's presentation. We're also recording today. So we'll send it out to all of you after. We'll also send it out to any other interested parties. But just wanted to let you know all of that, just housekeeping note before we continue.
And if we could send around the link of the
Yeah.
PowerPoint itself, because there's some links in there that could be useful.
Absolutely. We'll send you all of the resources after this.
Thank you, Phoebe. So how the housing needs assessment. So we recently published, or we published the original one back in 2019. Put it on the website, and then the world kind of fell apart with the pandemic, so it didn't really get a whole lot of attention. So we felt it was warranted to update it for this year. So we recently published the 2023 version back in October. And it's really kind of an all-intensive document that's really intended to serve as a resource for CHFA and its partners and provide as close to real-time data and trends to help make decisions for ourselves and you all as well. So it's split into generally kind of 4 different sections. It talks about demographics and the existing housing stock, the kind of pressures that the pandemic put on the housing stock. It talks about the housing gap analysis, which we'll get into in a bit, but that's like basically trying to put a number on the mixed match of units that are on the ground. And then another topic called market typologies that we're not going to get into today, but try to look at more kind of place-based solutions. We can get more into depth about that maybe another time. But it generally incorporates data from HUD, Census, CoStar, which is basically the back end of apartments.com, Zillow, Home Mortgage Disclosure Acts, and several other sources. And there you can see the link to the HNA website, just chfa.org/HNA. So to talk about the housing market, housing stock, we need to actually talk about who is living in those units. And so, you know, the narrative Connecticut's kind of told itself for the better part of 10, 15 years now is that we're either pretty flat in population or even declining in population. And to some extent, that's been true. So what you're looking at here is the percent change in household or percent change in population and the percent change in the number of households statewide and also by county. I apologize, I don't have the county equivalents, the planning regions yet, but that's coming. But this is just county here. So what you can see in green is that narrative over the last 5 years is more or less true. We are increasing in population in some areas, decreasing in others. But what is universally true across the board is that we're seeing an increase in the number of new households being formed. And just for reference, a household is formed basically anytime someone occupies a new housing unit. So the typical example is a recent college or high school graduate gets their first job, was living with their parents, but then moves into their first apartment. So that original household of 3 is now a household of 2 and a household of 1. So across the board in every single county, we're seeing an uptick in the number of new households. That's great. That's the driver behind, you know, the housing market, the general economy. But when we're not pairing that with enough new units, that's when some pressures start to arise on the housing market itself. So this is the building permits data back to 1966, shaded by the size of the building. It's being permitted for 1 unit, 2 unit, 3 or 4 and 5. And you can see back in the kind of 60s to the late 80s or so, it ebbed and flowed, but we were seeing annual numbers of upwards of 20,000 permits per year. That kind of dropped off in the 90s or so, and then we were hovering around, say, 10,000 units or so in the early 2000s, and then the Great Recession really hit us hard. We saw a pretty dramatic drop in the overall number of permits, but specifically in the number of permits for 1 unit construction in that kind of lighter green there. And we're, you know, since then we've been hovering around 5,000 to 6,000 units per year. And so what that also leads to is a kind of rapidly aging housing stock. So median age for Connecticut at large is 57 years old, compared to nationwide it's 44. And then in pockets, kind of those redder areas that you see there, you have areas, kind of zip codes, where the median age is upwards of 75 years or more. And I know there in Waterbury, the median age is 64 years old. So, you know, we're not meeting kind of that uptick in demand and new permits. And we're also, as a result, seeing our housing stock age pretty significantly. So when we talk about trends coming out of the pandemic, it's good to kind of keep that idea in mind that we've underbuilt, and then the pandemic caused a whole bunch of preference changes, increases in demand for really home buying specifically, but across the board. And it caused a whole bunch of ramifications thereafter. So what you're looking at here is the number of 1 to 4 unit home sales, specifically in the Naugatuck+Valley region from 2001 to really 2022, 2023. And you'll note that you see the run up to the recession, or run up to kind of recession, the drop off bottoming out in 2011 or so, that really kind of general recovery thereafter, with then beginning in 2021 and somewhat so in 2022, you see kind of outlier years relative to the years before. Statewide, we saw 61,000 home sales in 2021. That's the most since 2005. So a real uptick in demand. And then the year after, the Fed kind of steps in and kind of tries to cool things down. But what has not cooled down, as you can see here, is the median sales price. We're seeing that kind of continue to go up and up and up. And that's in part, again, because of supply constraints. So I think this is kind of the premier outcome of the pandemic, is the just bottoming out of what's called for sale inventory, meaning, you know, you log on to Zillow and you just type in Connecticut and you see what's for sale at any given time. We've seen that really crater in the statewide. So pre-pandemic 2018, 2019, we would have generally 18,000 homes for sale at any given time. There's some seasonality to that, but we'd hover around that range. And then again, or kind of starting March 2020, you see that number kind of just, we don't see the same seasonal increase that we did in years prior, and it's gone down really ever since. That's in part due to the uptick in sales, the opportunity to refinance in the current rate environment is really not attractive to list your home at the moment. But all that said, you know, the most recent data update, I think this is for October, we have under 6,000 unit homes for sale across the state. So roughly a third of what we would have normally pre-pandemic. And you see that blue line, that is for the country at large. The country at large has roughly about half of the homes that it would normal pre-pandemic time. So it's a problem nationwide, but it's a larger problem here in Connecticut and in the Northeast. So with that supply constraint, that obviously gives home sellers a lot more kind of market power in a transaction. So with the supply constraint, we've seen the percent of listings that sell above what they're listed for go through the roof. So again, pre-pandemic, that number would hover around 20%, depending on the month. March 2020 comes, that number jumps up, and nowadays we're seeing that number, you know, hover between that 50, 60, and then in some months approaching 80% of listings selling above what they're listed for. So not only are they homes going for more than they are listed for, but they're also going faster off the market. So this is the mean number of days a home goes from listed to pending. So basically when they're put on the market to when they're taken off, pending a sale. And again, same story, we see pre-pandemic, that number hovering at best about 50 days, 50 to 75 days. And then March 2020, that number drops well below 50, hovering around 20 to 30 days. And the most recent update for the New Haven metro area was about 19 days, so less than 3 weeks on average. So all that combined creates a pretty brutal market for first-time home buyers, right? You think we've all heard stories about folks waiving inspections, waiving contingencies, doing highest and best by a certain date. So that's a difficult market for folks, first-time home buyers, to compete with, not including what the Fed has done to raise interest rates to combat inflation. So this is the average 30-year fixed rate in green there back to 1971. Blue is the year-over-year change in that interest rate. And you can see we're hovering around, you know, it changes day to day, but, you know, 7.5 currently. Historically, you can see that is not abnormal. We had rates back in the 80s of upwards of 18% at its worst. But what is abnormal is the rate at which the rate has gone up. So between October 2021 and October 2022, we had the largest year-over-year increase in the average 30-year fixed rate since 1981. So you add that on top of all those factors, and you're just making it borderline impossible for first-time home buyers to compete in this current market. Switching over to the rental market, because these markets don't happen in a vacuum, right? Again, we saw beginning of 2020, rental vacancy rates drop pretty significantly. This is data from CoStar again, so apartments.com. We saw rental rates drop, or vacancy rates drop pretty notably, in part probably due to the eviction moratorium, strong demand, but also in part due to the single family market, the home buying market being also so competitive and basically blocking in potential renters who could be home buyers into their rental unit. That's driving down vacancy rates even further. You see these lines coming back up to approaching historic norms. But again, what very low vacancy rates does is gives landlords the opportunity to raise rents. So again, similar story, kind of a broken record. Beginning of March 2020, we saw year-over-year rental numbers start to skyrocket. For most areas in the state, that number peaked out around 7 or 8%. New Haven metro included, but the Norwich market led the way with year-over-year rent increases of upwards of 12%. That was a lot of bad news, obviously, a lot of doom and gloom, but this is kind of the one bright spot. So you see these numbers kind of coming back down to earth, so to speak, and the Fed watches this number very closely. But a third of what goes into their inflation estimates is rent increases. So as this number comes back down, the Fed might be a bit less hawkish on increasing rates. We could see some stabilization in mortgage rates, even some rate cuts, and that would do kind of a world of difference for maybe inventory levels in future years. Maybe some price declines, not the same kind of declines we saw in the Great Recession, but more of a kind of normalization into a more or less new normal. Before I get into the gap analysis, any questions there? That was a lot of info. Yep.
How is this market being affected by investors, absentee investors now, from what I hear, buying up the stock of housing and maximizing their value in it,
Right.
With regards to rentals and prices and all.
Right. It's hard to track. It is. We see sales, it's an estimate, but we see home sales from investors or by investors, roughly 10% of the market. It's higher in some urban areas like Waterbury or New Haven or wherever. It could be worse. We see, I think, in some of the markets down south, like Atlanta or Phoenix, it's much more of a problem.
Mhm.
But it's a bit, I would say, diminished in Connecticut relative to other areas.
Okay.
That makes sense. Any other questions? Yep.
Just curious how much you guys do in terms of the pipeline for construction permits? Because, there's a lag time, obviously, in new supply.
Mhm.
Governor Lamont was sort of talking about, we're building the most homes, obviously it's kind of a little bit inaccurate what he's saying, but there was a little bit of a mini boom. But do you guys track that ahead? I mean, are we really seeing the impact of the rate increases in the pipeline yet, or is it actually a wave coming later that's still gonna create scarcity?
I don't know. I think I have to get back to you and check my multifamily folks. We do track a pipeline. I just don't know how it tracks historically to what we've done in the past. So, but obviously higher rates are going to impact developers, right? And I think one of the programs later I'm going to talk about is a potential avenue to avoid those higher rates. Okay, so talking about the housing gap analysis. So this is kind of the crux of the H&A itself. It tries to actually pinpoint a number and point to, okay, where are actually the mixed match of units that are currently on the market. So the way the gap is calculated is it takes the number of households in a given AMI band, owners or renters in a given geography. So in this example, it's 0 to 30 AMI renters in Hartford County. And visually what it looks like is on the left, you see the number of households shaded by whether or not they're cost burden, the darker blue being cost burden. And on the right, you have the number of units that are affordable and available to them at any given time. And they are shaded by whether or not they are occupied in dark green by the quote unquote appropriate AMI level, or in light green, whether in this case they're occupied by a higher income renter. And then in gray, that's just vacant units. So what you can see here is that relative to the number of households, there's an outright shortage of units, right? The bar on the left is higher than the bar on the right. But, so that shortage exists, but the shortage is made even worse by the higher income households occupying housing that is appropriately priced for these renters. So it's kind of a twofold shortage in that way. And when we zoom out to the Naugatuck+Valley region, we see kind of what I call kind of a squeezing effect, and this resembles the trend statewide. So on the left, you have a outright shortage of units for folks earning under 30% AMI. On the right, there's an outright shortage of folks earning for renters earning above 80% AMI. So what that inherently means is those folks are forced into the middle of the market, so to speak. So while it looks like the 31 to 50 and the 51 to 80, there's more units than there are households, but they're also competing with higher and lower income renters. So just for reference, statewide, we found a gap of roughly 92,000 units for renters earning 0 to 30% AMI. National Low Housing Coalition has 89. Department of Housing did a study 2021, found, I think it was roughly 90. So we're like right in line with other estimates. In the Naugatuck+Valley region, we have the gap of roughly 12,000 units. We're not saying you have to build 12,000 units, but it's a measure of need in that area. On the homeownership side, it's a bit more of a nuanced story. So right away, you see a shortage of units for households earning above 100% AMI, surpluses elsewhere. But it's again a bit more nuanced because of what we know about the average homeowner, at least in pre-pandemic days. On average, homeowners would stay in their home for at least 7 years. So in theory, you could have had someone who bought when they were earning 75% AMI. They've since seen their income go up. So now they're in that more than 100% AMI household range, but they're occupying a unit that is in here. So, it doesn't really call for building more units that are affordable to folks above the median income, right? We don't want to use that to just build McMansions, so to speak. But I think what it does call for is a more or less maybe a starter home program to kind of make sure that cycle keeps going where someone can get their foot in the door, have their income go up over time while having an affordably priced home. Okay, so before I get into some of the new programs we're standing up, administering any questions on the gap analysis. Let me off easily. Okay, so kind of in reaction to what we've seen in the HNA and some other factors, we've been administering we're administering this program, and we're going to start administering another on behalf of the Department of Housing. The first being Time to Own. It's a program to help with down payment and closing costs for first-time home buyers. And the way it's set up is it's a 0% subordinate interest loan with no monthly payments, and 10% of the loan balance is forgiven for 10 years annually. So at the end of 10 years, the home buyer would owe nothing on that assistance. It covers up to 20% of the down payment, up to 5% of the closing costs. And the cap amount is $50,000 per borrower. To date, the State Bond Commission has already allocated $105 million, with the State General Assembly authorizing another $150 million over the next biennium. And I think we as an agency are really proud of the results. The volume of the program has been pretty significant. So since June of last year, we've helped roughly 2,500 home buyers with the program in 141 towns across the state. We've seen an average assistance amount of roughly $30,000. And to date, this is as of last week, we've seen a total reservation amount of $94 million. And just for note, you can see kind of a geographic distribution of where we've helped folks on the right there, but Waterbury and Hartford kind of go back and forth between being number one on the list. Just a little note. And I think what is really interesting about this program, given the kind of trends we showed earlier, how hot the market is it's really helping kind of middle income home buyers compete in what is otherwise a really tough market, right? So you can see we divided up our portfolio into recipients that got time to own and ones that did not. And you can see on the left, time to own recipients have a slightly lower income. They're able to compete for a slightly more expensive home, but their median monthly payment is actually lower than the rest of the portfolio. So it's helping them, get their foot in the door in what is otherwise a really, really tough market. So the other program, that tries to get at the, rental gap on the kind of that 80% AMI and above is, Bill for CT. This is actively being stood up, currently. Again, it's a program we're administering on behalf of DOH. It's basically a below market interest rate program for developers to construct, middle income housing, more or less. So the goal is to provide basically more flexible dollars to what are traditionally more market rate developers to create units that are what we kind of classify as the missing middle, quote unquote. We're funding through a network of designated middle income housing lenders. Can be structured as construction to permanent or permanent only, and rates, can be anywhere from 1% to 3%. And given the current interest rate environment, we think that's really attractive to developers. And then the cap on the per middle income unit is roughly $125,000. And we're requiring that at least 20% of the units be set aside for households earning 60 to 120% of the area median income. And again, I think this is really exciting because it's the first time we're kind of offering a product for a segment of the market that we don't really operate in, right? We cover everything between extremely low income all the way up to 80% in LIHTC and other loan products, but this is the first time we're kind of tapping into that kind of closer to market rate range. And I think that's really exciting given the kind of trends we're seeing from the gap analysis itself. And, I think if folks are interested in, if developers in the area that might be interested, you can visit our website or by get more information by emailing billforct@chfa.org. We will have a Bill for CT specific website up hopefully by early next year with way more information than I have for you right now. But yeah, it's an exciting opportunity, I think, for sure. And then lastly, just ways to keep in touch. We have a host of kind of CHFA data and research resources on our website. We have a blog called The Intersect. You can see the link there. We have a full research data and reports page on our webpage. We have also our just general listserv, chfa.org/sign up. If you have questions for me, my business card is over there, but you can also send an email to research@chfa.org. That's a shared email address I monitor with a colleague of mine. And then we have our marketing email if you're interested in kind of co-branding and you want any kind of marketing materials for any kind of events you have. You can feel free to reach out to marketing@chfa.org. And then lastly, the kind of shameless plug is just follow us on social media. We really appreciate it. And with that, I think we can just open it up for discussion. That was a lot of info I shared in 20 minutes, 30 minutes.
I had a question about the Build for CT program. Just what's the pool of funding available for that? Where was that originated in? How much?
It's bond commission or bond dollars. And I think it's 200 million over the next 2 years.
And are the requirements for that somewhere on CHFA's website in the app?
Yeah, there's like a 2-pager up there now. If you go to our webpage, it's on like the banner, you'll see it'll pop up right when you go there. There's a kind of 2-pager, just description of the program. Like I said, we're trying to have a webpage up in the next couple of weeks, so. And like I said, Phoebe, we can send the PowerPoint around with all the links to folks afterwards. Great.
Absolutely.
Yep.
I also had a question on the Build for CT program. Can you further qualify what you mean by like missing middle housing?
Yeah, it's kind of that term gets kind of thrown around.
Yeah, no, I know.
Yeah.
The general terms.
Yeah, it's kind of that range of units that are kind of priced for 60 to 120, where there's not like an existing affordable housing program available at the moment. So the term also workforce housing gets thrown around as well.
Actually, a related question to that. So under the definition of capital A affordable in the state statute of government assisted, does this count as government assisted?
That was the question I was hoping to avoid. The answer is sort of. If, a developer comes in and restricts a unit at 120, I don't think that would, this is all, I would defer you to DOH for the solid answer. I think the answer we've gotten is that to fit the letter of 830G, it needs to be affordable to folks at 80% AMI. And there also needs to be something with the utility assistance as well. So in theory, the units, they could qualify, but I don't think they qualify automatically like a line tech unit would, right? But again, I would defer to the equation on that definite answer. Any other questions? Great.
Well, thank you, Andrew. I enjoyed the presentation. I think everybody else here probably did as well and got some good information out of it. So for those of you who haven't met me, my name is Phoebe. You've been in correspondence with me probably about coming here today. I've worked with some of you before, so it's good to see you again. For those of you that I haven't worked with, those of you online as well, I hope I get to work with you in the future and I look forward to that. Now that you have seen this presentation, if you're with one of our municipalities and you'd like to talk to us about having us assist you or complete a housing needs assessment for your municipality, we would love to speak with you about that. So definitely reach out. We've completed 3 for some of our municipalities already, so we can send you some examples and we can talk about what that might look like for your community. I think that's all for today, probably. If you have questions you just want to talk about one-on-one or anything other than that, you know, we can hang around, we can snack, we can chat for a few more minutes here. So no rush to get out, but thank you to everybody who came here today. I really appreciate you all showing up and I hope that you enjoyed the presentation.
Thank you.
Thank you for having me.
Phoebe, you said it was 3 municipalities.
Thomaston, Naugatuck, and Watertown.
Want us to do Waterbury's next?
Nothing there.